On this episode of What's Going On with Shipping, containers fall while tankers rise. Hi, I'm your host, Sal Mercogliano. Welcome to today's episode. So, a lot going on in the shipping industry, obviously. The boom that was the container market is on the downward trend. We're seeing plunging rates. We're seeing decreased stock performance for container companies. But at the same time, because of what's happening in Russia, Ukraine, the longer distance involved in shipping oil, we're seeing tankers go through the roof. So we're definitely seeing two different sides of the marketplace right now. And I want to talk a little bit about it with you today. If you're new to the channel, take a moment, subscribe to the channel, hit the bell so you'll be alerted about new videos as they come out. All right, let's go ahead and jump into today's story. All right, the first story comes from the Financial Times. Container shipping costs plunge as consumer spending declines. I just want to go over the first part of this story because I think it really summarizes everything here. The price of shipping goods on vital global trade routes has fallen 85% below its peak at the cost of living crisis hits consumer spending and pandemic-related supply chain disruption eases. This month, it costs $1,444 to ship a standard 40-foot steel container from, I'm not sure what other containers there are than steel, but okay, from Eastern China to the U.S. West Coast at short notice. This is what's called spot rates versus long-term rates. According to shipper data specialist Zentia, down from a peak of 9,682 in March last year. The widespread delays and queues which hit ports at the height of the pandemic have also dissipated. We don't see that off LA Long Beach anymore. Very small delays off of Savannah and East Coast ports. Kiel Institute, a German think tank, said despite a monthly gain of 2.1% in January 2023, the quantity of goods shipped was down 5% from January 2022 levels. Behind the fall is a decline in demand for goods. And I would argue not just a demand for goods, but a shift in what type of goods are being demanded now. And that's impacting the total number of TEU coming over. Demand has plunged as inflation surged, triggering a severe cost of living crisis in several economies and leading eventual central banks to attempt to restrict spending with higher interest rates. The reopening of bars and restaurants and other facilities closed during the pandemic has led to more spending on services too. In the U.S., spending on goods is now down 5.4% in real terms from the March 2021 peak. In the UK, sale volumes are back below pre-pandemic levels after rising 10% above them in April 2021. Okay, what does that mean? Let's take a look at some charts and graphs that were provided by this report along with some other ones. So right here, short-term shipping costs have sunk to pre-pandemic levels. So this is the spot rate for booking containers, and you can see that massive uptick that happened initially when COVID hit in. We hit that plateau there going into 2021, and then all of a sudden it just took off into 2022. We had that peak rate there in 2022, and then off a cliff here to where we're at now, and we're still trying to find the bottom. The question is, where is that bottom? And we just don't know right now. Here's the long-term rates. Now, I should tell you that 70% of all goods that are shipped by sea go by long-term rates, not short-term rates. This is companies, entities like Amazon, Target, IKEA, you name it, big box stores, big consumers, consumers of goods who are going to book long-term, large volume on ships. We'll go by this rate. And you can see where this rate is. It's still pretty high. You're still looking at over $4,000 a cost from Asia to West Coast. The problem is the spot rate's going to keep pulling this down because the fear is that, okay, big consumers are going to cancel their long-term rates and go to the spot market. But understand, that's very risky. If everybody dumps into the spot market, you could see the spot market jump. The other thing that these charts are not showing you, which is really important, is the shift that's taking place from the West Coast cargo to the East Coast. We've seen that more than 50% of cargo is now going to the East Coast. We're seeing those rates coming down now. It all has to do with reliability and the fact that the West Coast still over 6 months now, since July 1st, don't have a new labor agreement on the West Coast. Add to it rail issues. You're seeing Class 1 rail issues across the board. The recent derailments in the United States highlight the problem with rail in the U.S. Issues with warehousing, with labor, with everything means that people are shifting to the East Coast warehousing, going into ports like Savannah, going into New York, New Jersey, going into Jacksonville, Charleston, Virginia, New Orleans, and Houston. They're just seeing this shift take place. And again, that's where the population center is. Moving on here, shipping companies have splurged on new vessels. We know about this, that we know there are new ships coming online. But understand, a lot of people are sitting there saying, well, we're going back to overcapacity. We're going to have overcapacity in the fleet. This is the reason we're seeing the drop. Understand, scrapping is going to go through the roof. People are going to scrap ships like crazy right now. There had been no scrapping of container ships from 2020 to 2022, almost none. That's going to change. And companies like Mediterranean Shipping, who bought a lot of secondhand tonnage, is going to have to start getting rid of that. Also, new fuel requirements are going to force ships to slow steam, especially the older vessels, because of the requirement to report your carbon emissions. This is going to mean more ships are needed to fill the same amount of slots. Add to it, we're seeing those blank sailings, those canceled sailings are taking place. You're seeing the numbers tick up. Now, again, we see this all the time with blank sailings during periods when shipping goes down, when the cargo volumes go down, they start canceling routes and vessels. They start removing them so that they can maximize the size on vessels. The new ships coming out are much larger, much more efficient. And the reason you're building large ships, you're not just building the ultra large container ships. Let's be clear about that. OOCL is just getting the first of 6 new 24,000 TEU vessels. They'd order those before the pandemic. The vessels they're ordering now are ships that can swing through the Suez Canal, through the Panama Canal, these Neo-Panamax vessels that you can load to the gills or half load them and still be very efficient. And when you start looking at the number of containers coming into the U.S., we are below the last 4 years in January. So we're seeing that, we're below. And what everyone is saying right now in February is we're going down. Well, look at the last 4 years. We always go down in February. February is always a downturn month. It always is, because of Chinese New Year, because of coming off the Christmas and holiday sales, because of overstock. We are always going down in February. The question is, does the predictions hold and we rebound into March, April, May, and into June? Do we hit that where we have a better year than we did in 2019 and 2020, but nowhere near the record levels of 2021, 2022? If you look at the monthlies right now for last year, all of the year to last year percentages are going to be down. We are less than what we did in 2022, and you're going to keep seeing that until you hit September, where you saw the fall off the cliff start to happen. So the question is, how are companies resizing themselves? What this means is companies that have a lot of Pacific exposure, and we saw this with quarterly reports by ONE and Matson, for example, you see them coming down. Companies that don't have as much exposure in the Trans-Pacific routes, Zim, for example, not down as much, but we can expect to see containers coming down. So when you look at container lessee companies, Triton and Textron, for example, you know, again, we're going to start seeing surge of containers. We've been building containers in China like crazy. We're going to hit a surplus of containers, which means the container lesser companies are going to see that return down. The charter companies, Atlas, Global Shipping, Customair, you know, those are companies that I would argue for a long time should have been doing very well in this period of time, yet some of them are not. Even though they have leases, they have fixed leases to container companies through 2024 into 2025 in some cases. However, some people I think they misdiagnose what these companies are. These are not companies like Zim, like Maersk, like MSC, like Hapag. These are companies like a U-Haul, where they lease the vessel to these companies and they get paid whether the ships are being used or not. And so they're pretty solid companies, but their performances don't show that. Then you come to tankers, and tankers is where everything's changing. Here's a Barron's story. Oil shipping stocks have soared. The rally might not be over. Tankers hired to ferry oil across the ocean have rarely been in higher demand. Even after larger gains, their stocks may still have open water ahead of them. Russia's invasion of Ukraine upended oil markets, causing crude prices to spike to 14-year highs. Oil producers were the most highly profitable profile winners from the high prices, but the biggest beneficiaries of the changes may have been a group of smaller and lesser known companies, oil tankers. Some of the stocks, including Ardmore Shipping, ASC, and Scorpio Tankers, STNG, quadrupled last year as new sanctions have shifted the flow of Russian oil to more distant ports. One analyst thinks the rally could keep going. This is a cycle that has some life, says Evercore analyst Jonathan Chappell. Let's look at some of the companies that I'm looking at right now. And again, let's be clear. I am a historian. I am not a financial advisor. I don't recommend anyone invest based on me, because if my guesses were right, I'd be a millionaire, billionaire, and I wouldn't have to do a YouTube channel. So here's some of the stocks that they mentioned. So here's Scorpio Tankers, and this is for 1 year, and you can see them sitting at 62.38 right now in their shares, a pretty good progression upward. Now, again, if you take all these charts and you go all the way out on them, one of the things you see is that the market used to be really, really good back in the 20-aughts, and then it bottomed out in the mid-2010s, but now what we're seeing is that kind of spring back here. And again, Barron's will give you recommendations. Don't take my advice. Look at their analyst ratings for what they say. Look at the volume they have. Look at their market share. Look at all the data you would normally look at. Don't take my word for it. Here's DHT Holdings. Again, DHT is another one of these crude oil companies. And again, very good performance we've been seeing here. So this is Euronav, and again, Euronav is that other company involved with Frontline in the merger. You can see the downward tick right here where that took place, but overall, you're definitely seeing an uptick across the board for this company. Come over here, Frontline, again, see that downward element there, and then the upward tick. And then the other companies we're looking at are companies like International Seaways, another company that's involved in crude oil and petroleum products. Definitely seeing it over the course of a year, increasing. Nordic American Tankers, same thing. And then TK Tankers, one of the biggest out there, with an overall increase across the board. I always use the analogy that a sailor drunk on money can spend the money in a poor way if they're not careful. So hopefully these companies are thinking about how to invest them. Maersk wants to become the Amazon of ocean shipping. MSC, on the flip side, really wants to become the biggest shipping company in the world. But again, they're not publicly traded, so they can do whatever they want. These other firms, these container lessee firms, these non-vessel owners out there, watch where they're going. It's going to be interesting to see what happens after the quarterly reports. But the big one are the tankers right now. Watch a tank and understand there's different tankers companies out there. There are crude oil carriers, there are product oil tankers, there are LNG carriers. There's a myriad of different things, and the different sectors react differently to different areas and also their place, where their markets, because of the fact that we're seeing oil shipped longer distances now than before, means that the fewer tankers are out there. Remember, tanker building is down. We don't have as many tankers as we had before. The Russians are buying up old tankers to put into the shadow fleet to move their oil around. And so what you have is less tankers, more product going longer distances. That's usually a good indication for the tanker sector to see an improvement. I hope you enjoyed today's video. If you did, hey, take a moment, subscribe to the channel, hit the bell so you'll be alerted about new videos as they come out. Leave a comment, share it across social media, give it a thumbs up, and if you can, especially if you're making money off me, go ahead and contribute to the page. How do you do that? You can hit that super thanks button down below to help the page, or head on over to Patreon. You can become a monthly, yearly subscriber to the page. I appreciate all the support. Again, this is Sal, signing off.